Hello and welcome. In the vast and often complex world of global finance, few terms are as intriguing or as misunderstood as tax haven. For many, the phrase conjures images of secret bank accounts on remote tropical islands, overflowing with illicit cash. While that picture isn't entirely without a basis in fiction, the reality is far more nuanced and deeply woven into the fabric of our global economy. This series will serve as an educational journey to demystify the world of offshore finance. We will explore what tax havens are, how they function, their history, and their impact on individuals, corporations, and governments, with a specific focus on the perspective of the United States. Before we proceed, it is essential to state a critical disclaimer that will apply to this entire series. The information provided here is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, investment, legal, or tax advice. The laws and regulations surrounding taxation and international finance are incredibly complex and subject to change. You should always consult with a qualified and licensed professional, such as a certified financial planner, attorney, or certified public accountant, before making any decisions related to your personal finances or legal obligations. This series does not endorse or encourage any activity that is illegal or in violation of any country's laws. Our goal is simply to shed light on a topic that is often shrouded in secrecy. So, with that important understanding in place, let's begin with the most fundamental question. What exactly is a tax haven? At its core, a tax haven is a country or jurisdiction that offers foreign individuals and businesses a minimal tax liability in a politically and economically stable environment. The key word here is minimal. This can range from a 0% tax rate on certain types of income to a very low, purely nominal rate. These jurisdictions create a deliberate strategy to attract foreign capital by establishing laws and financial systems that are highly favorable to outsiders. To be considered a tax haven, a jurisdiction typically needs to possess a few key ingredients. Think of it as a recipe. First and most obviously, is the tax structure itself. This is the primary lure. Many tax havens have no income tax, no corporate tax, no capital gains tax, and no inheritance tax, at least for foreign domiciled entities and individuals. Instead of taxing income, these countries might generate revenue through other means such as import duties, licensing fees for financial institutions, and registration fees for new companies. This creates an environment where money can be accumulated and transferred with little to no tax burden imposed by the haven jurisdiction itself. The second crucial ingredient is financial secrecy. Tax havens have historically been known for their strict bank secrecy laws. These laws make it a criminal offense for bank employees or officials to reveal any information about an account holder or their transactions to external parties, including foreign governments. This confidentiality is a powerful magnet. It offers a level of privacy that is not available in most other countries. While this privacy can be used for legitimate reasons, such as protecting assets from unstable political regimes or safeguarding personal information, it is also the feature that makes these locations attractive for illicit activities, such as tax evasion and money laundering. We will carefully distinguish between legal tax avoidance and illegal tax evasion later in this series, as this is a critical point. The third ingredient, which is often overlooked, is stability. For a country to succeed as a major financial center, it must have a stable government, a stable economy, and a reliable legal system. People and corporations will not move trillions of dollars to a location that is politically volatile or where the rule of law is not respected. This is why many well-known tax havens, such as Switzerland, the Cayman Islands, and Singapore, are known for their long-standing political and economic stability. They have established a track record of being safe and predictable places to store and manage wealth. It's also important to address a common misconception. The term tax haven can be controversial, and many of the jurisdictions labeled as such prefer to be called offshore financial centers or international financial centers. They argue that their primary role is to facilitate legitimate cross-border trade and investment, acting as neutral intermediaries in the global flow of capital. And indeed, a massive volume of legitimate financial activity does pass through these centers. Major corporations use them to structure their international operations efficiently, and investment funds use them to pool money from investors around the world. So, why do these places exist in the first place? For the jurisdictions themselves, it's a model for economic development. Many are small countries with limited natural resources. By becoming an offshore financial center, they can create a high-value service industry that provides well-paying jobs and generates significant government revenue without the need for traditional industries. They are, in essence, exporting financial legislation and services in exchange for foreign capital. In summary, a tax haven is not just a place with low taxes. It is a sophisticated ecosystem combining favorable tax laws, a high degree of financial secrecy, and a stable political and economic environment, all designed to attract capital from non-residents. As we move forward in this series, we will peel back the layers of this complex world. We will explore who uses these jurisdictions, from multinational corporations to ultra-high net worth individuals. We will examine the specific legal structures, like offshore trusts and shell corporations, that are used. And we will analyze the ongoing global efforts, often led by the United States, to increase transparency and combat illegal tax evasion. Thank you for joining me for this first chapter. We have laid the foundational groundwork for understanding this fascinating and critical component of the global financial system. Welcome back. In our first chapter, we define the core characteristics of a tax haven: a combination of low or no taxes, financial secrecy, and socio-political stability. But these complex financial centers did not simply appear overnight. Their existence is the result of centuries of political upheaval, economic innovation, and sovereign nations making strategic decisions to attract foreign capital. To truly understand how this system works today, we must journey back in time and explore its historical roots. As always, we must begin with our important reminder. This content is for educational and informational purposes only, and should not be considered financial, legal, or tax advice. The history we are about to discuss is complex, and the laws governing these matters are constantly changing. Always consult with a qualified, licensed professional for advice pertaining to your specific situation. Our aim here is to provide historical context, not guidance. The story of tax havens arguably begins not on a sun-drenched Caribbean island, but in the mountains of Europe. The pioneer, the blueprint for modern offshore finance, was Switzerland. The Swiss tradition of banking secrecy dates back to the 1700s, when the Great Council of Geneva prohibited bankers from revealing details about their clients, many of whom were wealthy French aristocrats seeking to protect their assets from the monarchy and later, from the French Revolution. However, it was the turmoil of the 20th century that cemented Switzerland's status. As Europe was torn apart by two world wars, Switzerland's steadfast political neutrality made it a unique safe harbor. It became a place where capital from all sides of the conflicts could be deposited for safekeeping. The pivotal moment came in 1934 with the passage of the Swiss Banking Act. This law made it a criminal offense, punishable by prison time, for a bank employee to disclose a client's identity to anyone, including foreign governments. While often viewed simply as a tool for secrecy, the historical context is crucial. The law was passed partly in response to attempts by Nazi Germany to investigate the assets of German Jews and others who had moved their wealth to Switzerland for protection. The principle was established. The relationship between a banker and their client was as confidential as that between a doctor and a patient or a lawyer and their client. This ironclad secrecy, combined with Swiss political neutrality, a strong currency and economic stability, created the gold standard for private wealth management and asset protection for decades. As the world moved into the post-World War II era, the model began to evolve and replicate. The next major chapter in our story unfolds in the Caribbean, with the decline of the British Empire. As former British colonies gained independence, many small territories that remained under British oversight, such as the Cayman Islands and Bermuda, needed to find a new economic path. They had little in the way of natural resources or industry. What they did have was a stable legal system based on British common law, and a connection to the financial powerhouse of London. A major catalyst for their growth was the rise of the Eurodollar market in the 1960s and 1970s. The term sounds complex, but the concept is simple. Eurodollars were US dollars held in banks outside the United States. These funds were not subject to the same regulations and reserve requirements imposed by the US Federal Reserve. This created a massive, free-flowing international pool of capital that needed a place to operate efficiently. Jurisdictions like the Cayman Islands saw an opportunity. They created legislation with zero corporate tax, zero income tax, and a welcoming regulatory environment. They became the perfect booking centers for these Eurodollar transactions. A bank in New York or London could route a loan through its Cayman subsidiary, freeing it from certain domestic regulations and taxes. This was a different model from Switzerland. It was less about personal secrecy for the ultra-rich, and more about providing a frictionless, tax-neutral hub for international corporate finance and banking. The final stage in this evolution brings us to the more modern era, with a focus squarely on corporate tax competition. jurisdictions like Ireland, the Netherlands, and Singapore developed a new model. Their appeal was not necessarily zero tax or absolute secrecy, but rather a very low corporate tax rate combined with a network of favorable tax treaties and specific legal structures. In the late 20th century, Ireland, for example, made a strategic decision to transform its economy by attracting foreign direct investment. It lowered its corporate tax rate to a fraction of the rate in the US and other major economies. This move was incredibly successful in attracting major US multinational corporations, particularly in the tech and pharmaceutical sectors. These companies could legally structure their global operations to attribute a significant portion of their international profits to their Irish subsidiaries, where those profits would be taxed at a much lower rate. This strategy was not about hiding money, but about legally minimizing a corporation's global tax burden by routing profits through low-tax jurisdictions. It marked a shift from secrecy-based havens to competition-based havens, sparking what many now call a global race to the bottom on corporate tax rates. So, we can see a clear historical progression. It started with the Swiss model of neutrality and secrecy to protect private wealth. It evolved with the Caribbean model, which acted as a regulatory and tax-neutral hub for the vast flows of the eurodollar market. And it has culminated in the modern model of corporate tax competition, exemplified by countries like Ireland, designed to attract multinational businesses. Each stage was a response to the political and economic realities of its time, creating the complex and interconnected system of offshore finance that exists today. Now that we understand the origins of this world, we can begin to look at the specific tools and techniques used within it. In our next chapter, we will delve into the engine room of the offshore world. The legal structures like shell corporations, trusts, and foundations that are the building blocks of international tax planning. Welcome back. In our previous chapters, we defined what a tax haven is and traced the historical arc of its evolution. Now we will open the hood and examine the engine itself. The offshore financial world operates using a specific set of legal tools and structures. These are the vehicles that allow assets to be held, managed, and moved within these low-tax jurisdictions. The three most fundamental building blocks are shell corporations, offshore trusts, and private foundations. Understanding these concepts is essential to understanding the entire system. As we begin, it is imperative to repeat our standard disclaimer. This chapter will describe these legal structures for purely educational and informational purposes. This is not legal or financial advice. The creation and management of such entities involve complex legal and tax obligations, particularly for U.S. citizens who have stringent worldwide reporting requirements. Any action in this area must be guided by licensed legal and tax professionals. Our goal here is simply to define and demystify these common terms. Let's start with the most widely known and often sensationalized tool, the shell corporation. A shell corporation is a company that exists legally on paper, but has no significant assets or active business operations. It has no office, no employees, and produces no goods or services. It is, in effect, a shell, a legal entity that can hold assets, open bank accounts, and enter into contracts. Setting one up in many offshore jurisdictions can be a remarkably fast and simple process, sometimes completed online in a matter of hours. The legitimate, stated purposes for a shell corporation can include serving as a holding company for the shares of other corporations, protecting intellectual property like patents or trademarks, or facilitating the assets of a complex merger or acquisition. For example, a company planning to launch a secret project might use an anonymous shell company to purchase land or assets without tipping off competitors. However, the very features that make them useful for legitimate privacy, anonymity, and the separation of the owner from the asset also make them a primary tool for illicit activity, because ownership can be obscured through the use of nominee directors and bearer shares, where ownership belongs to whoever physically holds the share certificate. Shell corporations can be used to disguise the origin of funds, evade taxes, or hide assets from creditors or in legal disputes. For U.S. citizens, it is critical to note that the Internal Revenue Service, or IRS, has extensive rules requiring the disclosure of ownership and control over such foreign entities. Next, let's discuss a more complex and historically rooted structure: the offshore trust. A trust is a legal arrangement where an individual, known as the settlor or grantor, transfers legal ownership of their assets to another person or entity, known as the trustee. The trustee is legally obligated to manage these assets for the benefit of a third party, the beneficiary. It's a way of separating legal ownership from beneficial ownership. When this arrangement is established under the laws of a foreign, low-tax jurisdiction, it becomes an offshore trust. These jurisdictions often have highly favorable trust laws, sometimes referred to as asset protection trust legislation. These laws are specifically designed to make it extremely difficult for future creditors, litigants, or other claimants from the settler's home country to access the assets held in the trust. For example, the laws in some jurisdictions might not recognize court judgments from other countries, forcing any legal claim to be relitigated from scratch in their own court system, often with very short statutes of limitations. From a theoretical standpoint, trusts are a long-standing tool for estate planning, allowing assets to be passed down through generations in a controlled manner, or to provide for beneficiaries who may be unable to manage the wealth themselves. An offshore trust takes this concept and adds powerful layers of asset protection and confidentiality. Again, for U.S. persons, creating and transferring assets to a foreign trust is a taxable event that triggers significant and complex IRS reporting requirements. Finally, let's touch upon the private foundation. On the surface, a foundation is established for charitable purposes. A wealthy individual or family might place assets into a foundation to create a philanthropic legacy, funding causes like education, healthcare, or the arts. In many countries, including the U.S., contributions to a foundation are tax-deductible. However, in some offshore jurisdictions, the rules governing private foundations can be much more flexible and private than in the United States. In certain legal frameworks, a private foundation can be established where the founder and their family can maintain significant control over the foundation's assets and activities. The definition of charitable purpose can be broad, and the disclosure requirements can be minimal. In some cases, the beneficiaries of the foundation can even include the founder's own family members under certain conditions. This can create a structure that, while having a charitable appearance, may be used primarily to shelter assets from taxation in the founder's home country, and control how that wealth is passed to future generations with minimal public scrutiny. In summary, shell corporations, offshore trusts, and private foundations are the primary instruments of offshore finance. Each serves to separate an asset from its original owner in a legally distinct way. A corporation creates a separate legal person to hold the asset. A trust transfers legal ownership to a trustee. A foundation dedicates the asset to a specific purpose. Understanding these basic mechanics is the next step in demystifying this complex world. In our next chapter, we will begin to connect these ideas to the real world by examining how multinational corporations use these tools and jurisdictions in a practice known as international tax planning. Hello and welcome back. In our last chapter, we identified the primary legal tools used in the offshore world: shell corporations, trusts, and foundations. Now we turn our attention from the tools themselves to the most powerful users of these instruments, multinational corporations. For a large global company, navigating the tax laws of dozens of different countries is a monumental task. This has given rise to a highly sophisticated field known as international tax planning. Its goal is to legally minimize the total amount of tax a corporation pays on its worldwide income. Before we explore these complex strategies, we must reinforce our foundational disclaimer. This information is for educational purposes only. It is intended to explain the concepts that are widely discussed in finance and economics. It is not, and should not be interpreted as, any form of tax, legal, or financial advice. The strategies discussed are incredibly complex, and their legality is dependent on the constantly changing laws of numerous jurisdictions. Always consult a qualified professional for guidance. At the heart of corporate tax planning is a simple, overarching principle. Recognize profits in low-tax jurisdictions and recognize costs in high-tax jurisdictions. Imagine a global company that does most of its research and development in a high-tax country like the United States or Germany, but sells its products all over the world. If it declared all its profits in that high-tax country, it would face a large tax bill. The objective, therefore, is to legally shift the profits earned from global sales to a subsidiary located in a country with a very low, or even 0% corporate tax rate. This practice is known as profit shifting. The primary mechanism used to achieve this is called transfer pricing. This is one of the most critical concepts in international finance. Transfer pricing refers to the prices that different divisions of the same multinational company charge each other for goods, services, or most importantly, intellectual property. Let's walk through a simplified, hypothetical example to make this clear. Imagine a fictional US-based tech company. Let's call it Innovate Corporation. Innovate Corp's brilliant engineers in California developed the valuable software code and brand logo for a new product. This software and brand are its intellectual property, or IP. Here's how a tax planning strategy might be structured. First, Innovate Corp sets up a subsidiary, Innovate Holdings, in a zero-tax jurisdiction like Bermuda or the Cayman Islands. It then sells the legal ownership of its new software and brand IP to Innovate Holdings for a relatively low price. Next, it sets up another subsidiary, Innovate Sales, in a low-tax country like Ireland, which will be responsible for selling the product to customers across Europe. Now, for Innovate Sales to be able to sell the product, it must have the legal right to use the software and the brand name. So, it pays a licensing fee, or a royalty, to Innovate Holdings, which now owns the IP. This is the crucial step. The transfer price, the royalty fee, is set to be very high. This means Innovate Sales in Ireland has massive costs in the form of these royalty payments. As a result, even if it generates billions in revenue from selling the product, its declared profit in Ireland is very small, because its costs are so high. Therefore, it pays very little tax in Ireland. So where did all the profit go? It flowed as royalty payments to Innovate Holdings in Bermuda, which pays zero corporate tax. The profit has been successfully shifted from the country where the customers are, Europe, and the country where the value was created, the US, to a zero-tax jurisdiction. This strategy is particularly effective for modern companies in the technology and pharmaceutical industries. Their most valuable assets are intangible, things like patents, source code, and brand value. It is much easier to argue about the correct price for the license to a brand logo than it is to argue about the price of a physical car or a ton of steel. This ambiguity provides significant flexibility in setting transfer prices. It is vital to distinguish between legal tax avoidance and illegal tax evasion. Tax avoidance is the use of legal methods to reduce one's tax liability. The strategies just described, when structured correctly according to the laws at the time, are generally considered tax avoidance. Tax evasion, on the other hand, is the illegal non-payment or underpayment of tax, for instance by deliberately hiding income or claiming false expenses. While the profit-shifting strategies employed by many corporations are legal, they remain highly controversial, raising ethical questions about corporate responsibility and whether these companies are paying their fair share to support the societies in which they operate and earn their revenue. In the next chapter, we will shift our focus from global corporations to the other major users of offshore finance, high net worth individuals, and explore the different strategies and motivations they may have. Hello and welcome back. In our last chapter, we dissected the complex world of corporate tax planning. Now, we turn our attention to the other major users of offshore financial centers, high net worth individuals. While the sums of money may be just as vast, the motivations and strategies for individuals are often quite different from those of a multinational corporation. For wealthy individuals and families, the focus is typically less on quarterly earnings and more on long-term wealth preservation, asset protection, and estate planning. As we delve into this topic, our standard disclaimer remains critically important. The following discussion is for informational and educational purposes only. It is a general overview of concepts in wealth management and is not legal, financial, or tax advice. U.S. citizens have significant and strict worldwide income and asset reporting requirements. Navigating these rules requires the guidance of qualified, licensed professionals who can apply the law to specific personal circumstances. For high net worth individuals, one of the primary drivers for looking offshore is asset protection. This is the concept of legally structuring one's assets to shield them from future potential threats, such as lawsuits, creditors, or even contentious divorce proceedings. The tool of choice for this purpose is often the Offshore Asset Protection Trust, which we introduced in Chapter 3. Let's revisit how this works conceptually. By transferring assets like cash, securities, or property into an irrevocable trust in a jurisdiction like the Cook Islands or Nevis, the individual, or settler, no longer legally owns those assets. The foreign trustee does. These jurisdictions have created laws that are intentionally hostile to foreign creditors. For a U.S. creditor to try and claim assets from such a trust, they typically cannot simply enforce a U.S. court judgment. They would likely have to hire local lawyers and relitigate the entire case from the beginning in that foreign country's courts, often under laws and deadlines that are highly favorable to the trust. This creates a formidable legal and financial barrier, discouraging all but the most determined claimants. The second major motivation is estate and succession planning. This involves planning for the orderly transfer of one's wealth to the next generation. Using an offshore trust or foundation can provide a vehicle to hold family assets, from financial portfolios to ownership of a family business, in a single, stable structure. The terms of the trust can dictate precisely how and when beneficiaries receive distributions, ensuring wealth is managed according to the wishes of the founder long after they are gone. This can prevent family disputes and protect assets from being squandered by heirs who may not be ready for the responsibility. A third key driver is financial privacy and confidentiality. While global transparency initiatives have significantly eroded old-school bank secrecy, many offshore jurisdictions still offer a degree of privacy that is unavailable in the U.S. For individuals of public renown, or those concerned about personal security, the ability to conduct financial affairs without that information being easily accessible can be a significant draw. It's less about hiding from the government, as reporting to tax authorities like the IRS is mandatory, and more about keeping financial details out of the public domain and away from potential litigants or media scrutiny. Finally, there is the advantage of investment diversification. Offshore financial centers provide access to a wider range of global investment opportunities, funds, and currencies that may not be readily available through domestic institutions. For a sophisticated investor, holding assets in multiple currencies and geographic locations can be a strategy to hedge against economic or political instability in any single country. It is absolutely crucial for our U.S. audience to understand that using these offshore structures does not eliminate U.S. tax obligations. U.S. citizens are taxed on their worldwide income, regardless of where it is earned or where their assets are held. Furthermore, the U.S. Treasury and IRS have implemented stringent reporting requirements. Forms such as the FBAR for foreign bank accounts and Form 8938 for specified foreign financial assets require detailed disclosure. Failure to comply with these reporting rules can lead to severe civil and even criminal penalties. Therefore, the narrative of simply moving money offshore to escape taxes is a dangerous and outdated misconception. In our next chapter, we will begin to look at the other side of this coin: the global crackdown on tax evasion and the push for international financial transparency. Hello and welcome back. For the last several chapters, we have explored the architecture of the offshore financial world. We've discussed what tax havens are, how they evolved, and the tools used by corporations and individuals. Now we must turn to the powerful counterforce that has fundamentally reshaped this landscape in the 21st century: the global movement towards financial transparency. The era of impenetrable bank secrecy is largely over, replaced by a new world of automatic information sharing. Before we examine the policies that changed the game, we must state our essential disclaimer. This chapter discusses significant international laws and regulations for educational context only. It is not tax or legal advice. These regulations are complex and have serious implications for U.S. persons with foreign assets. All such matters require consultation with qualified, licensed professionals. For decades, the balance of power favored financial privacy. Sovereign nations set their own secrecy laws, and tax authorities in other countries had to make specific requests for information, which were often slow-walked or flatly denied. The major turning point was the 2008 global financial crisis. As governments around the world spent trillions of dollars to bail out banks and stimulate their economies, they found themselves in desperate need of revenue. Public and political patience for wealthy individuals and large corporations legally avoiding taxes through offshore jurisdictions wore thin. This created the political will for a seismic shift. The first and most powerful move came from the United States. In 2010, Congress passed the Foreign Account Tax Compliance Act, or FATCA. This was a revolutionary piece of legislation. Instead of trying to chase information in hundreds of different jurisdictions, FATCA put the burden of reporting directly on foreign financial institutions themselves. Here is how it works in principle. FATCA requires all foreign banks, investment funds, and other financial institutions to report information about any accounts held by U.S. citizens and U.S. residents directly to the Internal Revenue Service, the IRS. You might ask, why would a foreign bank agree to do this? The answer lies in a powerful enforcement mechanism. If a foreign bank refuses to comply with FATCA, the U.S. can impose a punitive 30% withholding tax on all U.S. source payments made to that bank. This threat was so significant that it essentially gave foreign banks a choice: either report on your U.S. clients, or be effectively locked out of the U.S. financial system, the largest in the world. The choice was clear. FATCA single-handedly forced the world's banks to become, in effect, deputies of the IRS. Seeing the effectiveness of this unilateral American action, other countries wanted a similar capability. This led to the creation of a global standard.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Developed by the Organization for Economic Cooperation and Development, or OECD. It is called the Common Reporting Standard, or CRS. Think of CRS as a globalized, reciprocal version of FATCA. Over 100 countries have signed on to this standard. Under CRS, participating countries automatically exchange financial account information with each other every single year. For example, if a resident of France holds a bank account in Singapore, the Singaporean bank reports the account details to the Singapore Tax Authority. The Singaporean authority then automatically forwards that information to the French Tax Authority. The same happens in reverse, and between all other participating countries. This system is often referred to as the Automatic Exchange of Information, or AOI. Together, FATCA and CRS have created a net of financial transparency that covers most of the globe. They represent a fundamental change from the old system of information upon request to a new paradigm of automatic information exchange. This doesn't mean tax havens have disappeared, but it does mean their business model has had to change. The core offering is no longer absolute secrecy from tax authorities. Instead, it is about providing a stable, low-tax environment that operates within this new framework of global reporting. The game has shifted from hiding assets to structuring them in a tax-efficient, yet fully reported manner. In our next chapter, we will explore the crucial role of the enablers of the offshore world. The lawyers, accountants, and wealth managers who design and implement these complex structures, and the ethical lines they navigate. Hello and welcome back. We've explored the structures, the users, and the global regulations that define the offshore world. But these complex systems do not run themselves. Behind every offshore trust, every multinational tax strategy, and every confidential transaction is a network of highly skilled professionals. These are the lawyers, accountants, wealth managers, and specialized service providers who act as the architects and engineers of the offshore industry. They are often referred to in neutral terms as enablers because they make these complex international structures possible. As we proceed, please remember our consistent and crucial disclaimer. This chapter is for educational purposes only, providing a general description of a professional industry. It is not an endorsement of any activity and should not be taken as financial, legal, or tax advice. The work of these professionals is governed by strict laws and ethical codes, and anyone seeking such services must consult with licensed experts. Let's first look at the role of offshore law firms and tax attorneys. These legal experts are the architects. They are specialists in the laws of one or more low-tax jurisdictions, and also possess a deep understanding of the tax and reporting laws of high-tax countries, like the United States. Their job is to design legal structures, such as trusts and foundations, that are compliant with the laws of all relevant countries. They draft the complex legal documents, provide opinions on the legality of a proposed structure, and can defend that structure if it is ever challenged by tax authorities or other litigants. They operate at the intersection of different legal systems, finding pathways that are legally sound, even if they are highly complex. Next are the accountants and tax advisors. If lawyers are the architects, accountants are the engineers who ensure the numbers work. For multinational corporations, they perform the intricate calculations for transfer pricing, ensuring that all intercompany transactions are documented in a way that can withstand scrutiny from tax auditors. For individuals, they help clients navigate the labyrinth of reporting requirements, such as the FBR and FATCA forms for U.S. citizens. Their role is to ensure compliance and proper documentation, making sure that a client meets all their legal obligations while achieving the maximum legally permissible tax efficiency. Then we have the wealth managers and private bankers. These are the day-to-day supervisors and strategists. Once a structure is in place, the assets within it, cash, stocks, bonds, real estate, need to be managed. Private bankers at institutions in places like Switzerland or Singapore provide banking services, while wealth managers develop and execute an investment strategy designed to preserve and grow the client's capital. They are the client's primary point of contact, coordinating with the lawyers and accountants to ensure the overall financial plan is being executed effectively. Finally, there is a crucial group known as Trust and Company Service Providers, or TCSBs. These are firms based in offshore jurisdictions that provide the essential administrative infrastructure. When a shell company is created, it needs a registered address, a mailing address, and nominee directors to maintain the client's privacy. When a trust is established, it needs a licensed trustee to legally manage it. TCSBs provide these exact services. They can act as the registered office for thousands of different companies and serve as the professional trustees for countless trusts, making the on-the-ground administration of the offshore world possible. This professional ecosystem operates within a framework of legal and ethical obligations. Professionals are bound by codes of conduct that require them to act in their clients' best interests while also complying with the law. With the rise of global transparency, their responsibilities have grown immensely. They are now on the front lines of anti-money laundering and know your customer regulations, legally required to conduct due diligence on their clients to verify their identities and the legitimate source of their funds. A failure to do so can result in massive fines, and even the loss of their license to operate. This places these enablers in a complex position. Their duty is to their client, but they also have a duty to the legal and regulatory systems in which they operate. The line between creative legal tax avoidance and illegal tax evasion can sometimes be a fine one, and it is the responsibility of these professionals to ensure that line is never crossed. In our next chapter, we will explore some of the most famous real-world examples and data leaks, such as the Panama Papers, that have given the public a rare glimpse into the inner workings of this secretive world. Hello and welcome back. For much of its history, the offshore financial world operated under a thick veil of secrecy. While its existence was well known, the specific details of who was using it and for what purposes were largely hidden from public view. That all changed in the 2010s, when two of the largest data leaks in history ripped that veil away, exposing the inner workings of the industry to the entire world. These were the Panama Papers and the Paradise Papers. Before we discuss their revelations, it is absolutely essential to apply a critical disclaimer. The information in this chapter is a factual retelling of historical events. Being named in a data leak is not, by itself, proof of any illegal activity. There are legitimate reasons for utilizing offshore companies and trusts. However, these leaks provided an unprecedented, unfiltered look into a world that was previously invisible, sparking a global debate about wealth, secrecy, and fairness. This content is for educational context only, and is not legal advice. The first seismic shock came in 2016 with the Panama Papers. An anonymous source leaked an astounding 11.5 million documents, totaling 2.6 terabytes of data, from a single Panamanian law firm called Mossack Fonseca. This firm was one of the world's largest creators of shell companies. The documents were shared with the International Consortium of Investigative Journalists, or ICIJ, which coordinated a global investigation involving hundreds of journalists. What the Panama Papers revealed was staggering. The documents detailed the offshore holdings of dozens of current and former world leaders, hundreds of other politicians and public officials, billionaires, celebrities, and sports stars. For the first time, the public could see the specific techniques we've discussed in this series being used in practice. The files were a raw ledger of shell companies in the British Virgin Islands, foundations in Panama, and anonymous bank accounts, all interconnected in complex global webs. The leak exposed clear evidence of tax evasion, money laundering, and the skirting of international sanctions in some cases. But just as importantly, it showed the vast scale of legal tax avoidance, making the abstract concepts of offshore finance deeply personal and political. The fallout was immense, leading to public protests, the resignation of heads of state, and triggering thousands of official investigations around the globe. Just a year later, in 2017, a second major leak occurred, the Paradise Papers. This leak was different. It consisted of 13.4 million documents, but a large portion came from a single, highly reputable offshore law firm named Appleby. This firm was not a mass producer of shell companies like Mossack Fonseca. It was a top-tier advisor to the global elite, including Fortune 500 corporations and ultra-high net worth individuals. Consequently, the Paradise Papers shone a bright light on the corporate playbook we examined in Chapter 4. It revealed the highly complex and technically legal tax minimizing strategies used by some of the world's largest and most well-known technology companies, pharmaceutical giants, and consumer brands. The documents detailed how profits from intellectual property were routed through jurisdictions like Ireland and Bermuda, and how intricate trust structures were used by the ultra-wealthy for estate planning and asset protection. While the Panama Papers exposed a grittier side of the offshore world, the Paradise Papers exposed its sophisticated, corporate, and often legally sound, though ethically controversial, side. Together, these two leaks transformed the global conversation. They moved the topic of tax havens from the business pages to the front pages of newspapers worldwide. They provided concrete proof of the scale of offshore wealth, which academics had previously only been able to estimate. Most importantly, they created enormous political pressure on governments to act, accelerating the adoption of transparency measures like the Common Reporting Standard, and fueling a global movement to ensure that large corporations and wealthy individuals pay their fair share of tax. The age of assuming that what happened offshore would stay offshore was definitively over. In our next chapter, we will bring the focus back to the United States and look at how the IRS and the U.S. government specifically work to combat offshore tax evasion by its own citizens. Hello and welcome back. After witnessing the global scale of offshore finance through massive data leaks, we now narrow our focus to the United States. The U.S. government, primarily through the Internal Revenue Service or IRS, has been at the forefront of the global fight against offshore tax evasion. It employs a powerful and multi-pronged strategy, combining strict reporting laws, aggressive legal action, and sophisticated data analysis to ensure its citizens pay tax on their worldwide income. As we discuss these enforcement mechanisms, our standard disclaimer is more important than ever. This is an educational overview of U.S. tax enforcement policy and is not legal or tax advice. The rules are extremely complex and the penalties for non-compliance are severe. All U.S. taxpayers with international financial ties must seek guidance from qualified, licensed professionals. The entire foundation of U.S. offshore enforcement rests on a unique and powerful principle: citizenship-based taxation. Unlike most other countries that tax based on residency, the United States taxes its citizens and permanent residents on their worldwide income, regardless of where they live or where that income is earned. This gives the IRS the legal authority to pursue income hidden in any corner of the globe. The first and most fundamental tool in the IRS's arsenal is a web of comprehensive reporting requirements. The government's strategy is to legally obligate taxpayers to self-report their foreign assets. The most well-known of these is the FBAR, or Report of Foreign Bank and Financial Accounts. Any U.S. person with a combined total of over $10,000 in foreign financial accounts at any point during the year must file an FBAR with the Treasury Department's Financial Crimes Enforcement Network, or FinCEN. This is not a tax form, it is a disclosure form. Failure to file it can result in steep civil penalties, and in willful cases, even criminal prosecution. Layered on top of this is Form 8938, which was created by FATCA and requires reporting of a broader class of foreign assets directly to the IRS with one's tax return. When diplomacy and self-reporting fail, the IRS uses powerful legal tools. One of the most effective has been the John Doe summons. Normally, a legal summons names a specific person. A John Doe summons, however, can be issued to a third party, like a bank, to demand information on an entire class of unidentified taxpayers. For example, all U.S. clients of a certain Swiss bank who have not provided proof of tax compliance. The U.S. Department of Justice famously used this tool in 2009 against the Swiss banking giant UBS. The resulting legal battle forced UBS to turn over the names of thousands of American clients, shattering the long-held belief that Swiss bank secrecy was impenetrable and sending a shockwave through the offshore world. Another critical source of information comes from the IRS whistleblower program. This program offers significant financial rewards, up to 30% of the amount recovered, to individuals who provide specific and credible information about major tax fraud. This creates a powerful incentive for insiders at foreign banks, law firms, or corporations to report wrongdoing, effectively turning potential accomplices into informants. Finally, the IRS offers both a carrot and a stick. The stick is the IRS Criminal Investigation Division, or CI. This is the law enforcement arm of the IRS, comprised of federal agents who investigate and recommend prosecution for tax crimes, which can lead to prison sentences and massive fines. The carrot, on the other hand, has been a series of voluntary disclosure programs. These programs were designed to allow taxpayers who were not yet under investigation to come forward, declare their hidden assets, pay back taxes and penalties, and in exchange, generally avoid criminal prosecution. This has been a remarkably effective strategy, bringing tens of thousands of taxpayers back into compliance and recovering billions of dollars in unpaid tax. In summary, the U.S. employs a comprehensive strategy. It requires citizens to report everything, uses legal force to break open foreign secrecy, encourages whistleblowers, and combines the threat of criminal prosecution with a path back to compliance. In our next chapter, we will analyze the broader economic and ethical consequences of tax havens. Hello and welcome back. Thus far in our series, we have explored the mechanics, the history, the users, and the regulation of the offshore financial world. We've answered the what and the how. Now we must confront a more profound question. So what? What is the real-world cost of this system? In this chapter, we will delve into the economic and social impacts of tax havens and the intense ethical debates they provoke. As we discuss these impacts, please remember our standard disclaimer. This content is for educational purposes only and presents a summary of economic research and public debate. It is not financial or legal advice. The numbers cited are estimates from various economic studies, intended to provide context to the conversation. The first and most direct impact is on government revenues. A central question for economists and policymakers is, how much money are we talking about? Accurately measuring wealth hidden in secretive jurisdictions is incredibly difficult by its very nature. However, economists like Gabriel Zuckman, through painstaking analysis of global financial data, have produced influential estimates. Their research suggests that trillions of dollars of the world's financial wealth are held offshore. This massive concentration of offshore wealth translates directly into lost tax revenue. Organizations like the Tax Justice Network estimate that governments worldwide lose hundreds of billions of dollars each year from both corporate profit shifting and undeclared individual offshore wealth. This is not a victimless activity. That lost revenue is money that would otherwise be available to fund essential public services. Things like building and repairing roads, funding schools and hospitals, supporting scientific research, and providing for national defense. This leads to a secondary effect, a shifting of the tax burden. When a significant slice of corporate profits and the wealth of the richest individuals is taxed at very low or zero rates, the responsibility for funding the government does not disappear. Instead, it is shifted onto others. This often means that middle-class wage earners and small, domestic businesses, who cannot access complex international tax strategies, end up bearing a larger proportion of the overall tax burden. This dynamic is at the very heart of the debate about fairness. The social consequence of this is a potential rise in inequality. The offshore system arguably creates a two-tiered world. The first tier is for the globally mobile, large multinational corporations and high-net-worth individuals who can afford the sophisticated legal and accounting advice needed to navigate this world. The second tier is for everyone else. Critics argue that this allows wealth to beget more wealth at an accelerated rate, as the assets of the very rich can grow in a low-tax environment, compounding faster than the savings of ordinary citizens who pay their full share of taxes. This constrains social cohesion and public trust in the fairness of the economic system. To ensure a balanced discussion, it is also important to present the arguments made in defense of offshore financial centers. Proponents of the system argue that tax competition is a healthy and necessary force. They contend that it acts as a check on governments, preventing them from raising taxes to excessive levels that could stifle investment and economic growth. From this perspective, offshore centers provide a crucial function in the global economy by offering a stable, tax-neutral platform where capital from around the world can be pooled efficiently for international investments. They argue these centers are not harming the global economy, but are in fact providing the essential grease that keeps the wheels of global finance and commerce turning smoothly. Ultimately, the debate boils down to a fundamental disagreement over the purpose and morality of taxation and the role of a nation-state in a globalized world. It is a conflict between those who see a system that undermines public finance and promotes inequality, and those who see a system that fosters efficiency and disciplines governments. In our next chapter, we will look to the future and examine the major international reform efforts currently underway. Hello and welcome back. We've journeyed through the history, mechanics, and controversies of the offshore world. We've seen how a global crackdown on secrecy has changed the rules of the game. Now we look to the horizon. What is the future of tax in a globalized world? The most significant development is a historic international agreement, brokered by the OECD, that seeks to fundamentally rewrite the rules of international corporate taxation. As we discuss this monumental shift, our disclaimer remains essential. This chapter provides a high-level, educational overview of a complex and evolving international tax agreement. It is not financial or legal advice. The implementation and effects of these rules are still unfolding and require expert analysis for any specific situation. For decades, the core issue has been a race to the bottom, where countries compete to attract corporations by lowering their tax rates. The landmark OECD/G20 Inclusive Framework Agreement aims to end this race. It consists of two main parts, referred to as Pillar 1 and Pillar 2. Pillar 2 is the part that has gained the most momentum and is the most revolutionary. It establishes a global minimum corporate tax rate of 15%. This applies to large multinational enterprises with annual revenues over 750 million euros. The goal is to ensure that these large corporations pay at least a minimum level of tax on the profits they earn in every single jurisdiction where they operate. Here's the basic concept. If a multinational company reports profits in a country that has a corporate tax rate of, say, 5%, that company will be subject to a top-up tax to bring its total tax on those profits up to the 15% minimum. This top-up tax would generally be collected by the country where the company's ultimate parent entity is headquartered. This simple but powerful mechanism fundamentally removes the incentive for companies to shift their profits to a zero-tax or very low-tax haven. If the profits are going to be taxed at 15% somewhere, regardless of where they are booked, the advantage of using a traditional tax haven largely disappears. Pillar 1 is the second part of the agreement, and it is designed to address the challenges of the modern digital economy. For a century, tax rules were based on physical presence. But what about a massive digital streaming service or social media company that earns billions from users in a country without ever having an office there? Pillar 1 seeks to change the rules so that a portion of the profits of the very largest and most profitable multinational corporations are reallocated and taxed in the countries where their customers and users are located, regardless of the company's physical presence. This is a move away from taxing where a company is headquartered to taxing where it makes its sales. What does this mean for the future of tax havens? Their business model must evolve or risk becoming obsolete. Jurisdictions that built their economies on offering a 0% corporate tax rate may no longer be as attractive for profit-shifting purposes. Many of these jurisdictions are now implementing their own domestic 15% minimum tax. By doing so, they get to collect the tax revenue themselves, rather than letting the multinational's home country collect it as a top-up tax. The competition is shifting away from tax rates and towards other factors, like stability, legal expertise, and regulatory efficiency. This global reform is the most significant overhaul of international tax rules in over a century. It represents a new era of international cooperation, aimed at creating a more level playing field, and ensuring that large, profitable companies contribute to the public finances of the countries in which they do business. In our next chapter, we will discuss the practical challenges and criticisms of these new global tax rules. Hello and welcome back. In our last chapter, we outlined the historic global agreement to fundamentally reshape international taxation, centered around a 15% global minimum tax. On paper, it represents an unprecedented leap forward in global cooperation. However, no reform of this magnitude is without its critics, complexities, and potential weaknesses. In this chapter, we will provide a balanced look at the significant challenges and criticisms facing these new rules. As always, we must begin with our disclaimer. This chapter discusses various viewpoints on international tax policy for educational purposes only. It is not legal advice or political commentary. The issues are complex, and the arguments presented reflect the ongoing debate among economists, policymakers, and civil society organizations. One of the most immediate and widespread criticisms is aimed at the rate itself. Is 15% too low? While a 15% floor is certainly higher than zero, many tax fairness advocates argue that it is still well below the average statutory corporate tax rate in most developed nations. The concern is that instead of ending the race to the bottom, the agreement might simply legitimize a new global standard of 15%, causing the global average to fall and ultimately reducing the overall tax revenue collected from corporations. A second major area of concern revolves around loopholes and carve-outs. To encourage companies to maintain real economic activity, the agreement includes a substance-based income exclusion. This allows companies to exclude a certain amount of their profit from the minimum tax based on the value of their tangible assets, like factories and equipment, and their payroll in a given country. While intended to reward real investment, critics argue this creates a significant loophole. A company could still book large amounts of profit in a low-tax country and shield a portion of it from the top-up tax, as long as it has enough physical substance there. This could create new, complex tax planning games. Third, there is the monumental challenge of implementation and complexity. The rules for this new global system are incredibly intricate, running hundreds of pages. Over 140 countries have agreed to the framework, but each one must now translate these complex rules into its own domestic legislation. This process is fraught with potential for inconsistencies, creating legal uncertainty for businesses, and the risk of disputes between countries over who has the right to tax what. The sheer complexity could become a barrier to the system's effectiveness. Fourth, there is a crucial debate about fairness for developing countries. Many leaders and economists in the global south have argued that the deal was primarily designed by, and for the world's richest nations. A key criticism is that the rules give the primary right to collect the top-up tax to the country where a multinational is headquartered. This means wealthy nations, where most corporate headquarters are located, would collect the majority of the new revenue, while lower-income countries, where much of the actual labor and sales might occur, could be left with little. Finally, some critics raise the issue of national sovereignty. They argue that a global minimum tax infringes on the fundamental right of a sovereign nation to set its own domestic tax policy. From this perspective, if a country wishes to attract investment by offering a competitive, low-tax environment, it should be free to do so without being overridden by a global consensus. In conclusion, while the global minimum tax represents a historic effort to curb tax avoidance, its ultimate success is not guaranteed. It faces significant hurdles, from a potentially low rate and built-in loopholes to immense implementation challenges and questions of fairness. In our next chapter, we will take a closer look at some of the most prominent tax haven jurisdictions. Hello and welcome back. We have spent a great deal of time discussing the concepts and policies that shape the offshore world. Now let's ground this discussion by looking at three of the most significant jurisdictions in the system. Each one has a unique history, a distinct business model, and is adapting to the new era of global transparency in its own way. We will explore the classic model of Switzerland, the investment hub of the Cayman Islands, and the modern powerhouse of Singapore. Before we begin, a brief reminder that this is an educational comparison of different financial systems. It is not an endorsement or recommendation of any jurisdiction, and should not be construed as financial or legal advice. First, let's look at Switzerland. As we discussed in our history chapter, Switzerland is the original blueprint for a tax haven, built on a foundation of stability, neutrality, and legendary banking secrecy. For centuries, its primary business was providing discreet, secure private banking for the world's ultra-wealthy. However, with the death of absolute bank secrecy due to FATCA and the Common Reporting Standard, Switzerland's model has been forced to evolve. It can no longer compete on secrecy alone. Instead, it has pivoted to emphasizing its other core strengths: a long-standing tradition of expertise in wealth management, a highly skilled financial workforce, and unparalleled political and economic stability. Today, Switzerland markets itself as a premier, high-quality, and now compliant center for managing global wealth, focusing on providing sophisticated investment advice and preserving capital for generations. Next, we journey to the Caribbean to the Cayman Islands. The Caymans built their reputation not on centuries-old private banking, but on a nimble, modern, and highly specialized legal framework. The jurisdiction's primary business is not individual bank accounts, but serving as the world's dominant hub for investment funds. The vast majority of the world's hedge funds and many private equity funds are legally domiciled in the Cayman Islands. The reason is its tax neutrality, its use of familiar British common law, and its sophisticated, flexible, and business-friendly legislation. For a fund manager in New York or London who is pooling money from investors in Japan, Brazil, and the Middle East, the Cayman Islands offers a neutral and efficient legal platform to house the fund, free from any extra layers of local taxation. Its model is less about secrecy and more about serving as a crucial, low-friction intermediary in the global flow of institutional capital. Finally, we turn to Singapore. Singapore represents the new face of global wealth management. It has strategically positioned itself as the leading financial hub for Asia, a region experiencing the fastest growth in new wealth. Singapore's model is built on a combination of factors: rock-solid stability, a highly reputable legal and regulatory system, a network of favorable tax treaties, and a government that actively cultivates the financial services industry. While it offers privacy, its main selling point is being a compliant, well-regulated, and efficient gateway for investors looking to tap into the high-growth markets of Asia. It has become a major competitor to Switzerland in the private wealth space, and is also a key hub for corporate headquarters and asset management in the region. Singapore's model is one of proactive, government-led strategy, combining the stability of the old world with the dynamism of the new. In these three examples, we see a clear evolution, from Switzerland's classic model of private secrecy, to the Cayman Islands' specialized role as a legal hub for global capital, to Singapore's rise as a modern, compliant, and dynamic center for Asian wealth. In our next chapter, we will discuss the concept of onshore tax havens. Hello and welcome back. Throughout this series, we have generally spoken of tax havens as foreign, offshore jurisdictions, places like Switzerland, Bermuda, or the Cayman Islands. But what if I told you that some of the world's most effective financial secrecy jurisdictions can be found right here, within the borders of the United States? In this chapter, we will explore the surprising and complex world of onshore tax havens. As we discuss this sensitive topic, it is imperative to re-emphasize our educational purpose. This chapter describes specific state laws and their effects as reported by journalists and academic researchers. It is not legal advice, nor is it an instruction manual.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
The distinction between legal privacy and illegal secrecy is a matter of intense legal debate and requires professional guidance. The irony of the U.S. as a secrecy jurisdiction lies in a simple fact. While the U.S. government pioneered global transparency for its own citizens with FATCA, it has not adopted the reciprocal global standard, the Common Reporting Standard or CRS. In simple terms, this creates a one-way street. A Swiss bank must report on its American clients to the IRS. However, a U.S. bank is generally not required to automatically report on a Swiss client to the Swiss tax authorities in the same comprehensive way. This has made the U.S. one of the most attractive places for non-U.S. persons to place their assets, benefiting from the stability and security of the American financial system, while enjoying a level of privacy from their home governments that is no longer available in traditional offshore centers. This dynamic plays out at the state level, where a handful of states have passed laws that are highly favorable to asset protection and corporate secrecy. Let's look at two prominent examples. First is Delaware, which is less a tax haven and more a corporate secrecy haven. For over a century, Delaware has been the legal home for the majority of America's largest corporations. This is due to its specialized and highly respected business court system. However, it is also incredibly easy to form a limited liability company, or LLC, in Delaware without disclosing the names of the owners, who are known as the beneficial owners. The public record may only list the name of a registered agent. This corporate anonymity makes Delaware a prime jurisdiction for creating legal entities where the ultimate ownership is opaque. An even more striking example is South Dakota. In recent decades, South Dakota has transformed itself into a global hub for the ultra-wealthy by creating the most powerful trust laws in the world. It has attracted hundreds of billions of dollars in trust assets. The state offers several key advantages. First, it has no state income tax or capital gains tax. Second, its trust laws provide formidable asset protection, making it extremely difficult for creditors to access assets placed in a South Dakota trust. Third, and perhaps most importantly, it allows for the creation of dynasty trusts that can exist forever or for many generations, shielding family wealth from federal estate taxes with each passing generation. Finally, it has some of the strongest privacy statutes in the nation, sealing all court records related to trusts, ensuring near total confidentiality. For a wealthy family from abroad, a South Dakota trust offers the secrecy of a traditional offshore haven combined with the safety and stability of the United States. It is critical to understand the distinction for U.S. persons. For an American citizen, using a trust in South Dakota or an LLC in Delaware does not help them evade U.S. federal income tax. The IRS still sees everything. For them, the benefits are primarily about asset protection from lawsuits and sophisticated estate tax planning. The game changes for non-U.S. persons, for whom the United States can function as a premier and secure offshore jurisdiction. In our final chapter, we will conclude our series by summarizing the key takeaways and offering a final look at the future of wealth and transparency. Hello, and welcome back for the final chapter in our educational journey through the world of tax havens. Over the last 14 chapters, we have explored this complex and often controversial corner of the global economy. We began by defining what a tax haven is, not just a place with low taxes, but a sophisticated ecosystem combining favorable laws, financial privacy, and stability. We traced its history from the secretive banking traditions of Switzerland to the modern, corporate-focused hubs of the Caribbean and beyond. We examined the specific tools of the trade, from shell corporations to intricate offshore trusts. We saw how these tools are used in two very different playbooks. The corporate playbook, focused on legally shifting profits to minimize taxes, and the individual playbook, often centered on asset protection, estate planning, and financial privacy. Then the story shifted. We saw how the 2008 financial crisis and shocking data leaks like the Panama Papers created a powerful political demand for change. This led to a global crackdown, spearheaded by the United States with its powerful FATCA law, and expanded globally with the Common Reporting Standard. This fundamentally changed the game, effectively ending absolute bank secrecy for tax purposes, and ushering in an era of automatic information exchange. We have seen how the world is now attempting to go one step further with a global minimum tax, a historic effort to end the race to the bottom. Yet, we also examined the criticisms and challenges that this new framework faces. We explored the different business models of major financial centers, from Switzerland to Singapore, and even looked in our own backyard at the rise of onshore havens within the United States. So what is the key takeaway from this entire series? It is that the world of offshore finance is best understood as an unending tug-of-war between two powerful and legitimate human desires: the desire for privacy and the desire for fairness. On one side is the impulse to protect one's assets, to maintain confidentiality, and to legally minimize one's tax burden. This drives individuals and corporations to seek out jurisdictions that offer stability and favorable laws. On the other side is the collective need for governments to fund public services, from roads and schools to healthcare and defense, and the public demand that the tax burden be shared equitably among all citizens and businesses. The history of tax havens is the history of this conflict. For every new tax law, a new avoidance strategy is developed. For every new loophole, a new regulation is written to close it. The global minimum tax and the automatic exchange of information are the most powerful moves yet by the side of transparency. But the world of finance is endlessly innovative. The competition will now shift away from pure secrecy and toward other factors: legal ingenuity, regulatory efficiency, and national stability. The era of hiding undeclared money in a secret bank account is largely over. The future is one of compliance and reporting. The structures will become more complex, the legal advice more sophisticated, but the fundamental tension will remain. As long as there are differences in tax rates and laws between countries, and as long as capital is free to move across borders, this fascinating and critical part of our global economy will continue to evolve. Thank you for joining me on this extensive and detailed exploration.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.